Hello, everyone. If you're a Canadian small business owner, then you've almost certainly heard of the lifetime capital gains exemption. It's a huge tax break. But what if I told you that your own success, literally having too much cash sitting in the bank, could be the very thing that stops you from qualifying for it? Let's get into it. For so many Canadian entrepreneurs, the lifetime capital gains exemption is, well, it's the holy grail of tax planning. But it comes with a catch, a really big one. And that is, if you have too much cash just sitting in your company, you can be completely disqualified. Today, we're going to look at a very common strategy that people use to try and fix this, something called ongoing purification, and I'm going to show you why it often creates way more problems than it actually solves. So here's our game plan. First, we'll talk about what's at stake with something called the asset test. Then we'll look at the solutions people propose, before digging into why the two most common strategies are actually pretty flawed. And we'll wrap it all up with a clear conclusion on why this whole approach is, frankly, often not the best path. Okay, so let's set the stage. This whole issue, it all comes down to something called the Qualified Small Business Corporation Asset Test. I know, it sounds super technical, right? But the idea behind it is actually pretty straightforward. It's all about what your company owns, and those assets are what determine whether you get that massive tax exemption. So, what's the biggest threat to qualifying? Well, ironically, it's often a sign of success. It's that pile of cash that a really profitable, well-run business naturally builds up over the years. All right, here's the rule you have to know. To qualify, at least 90% of your company's assets, and this is based on their fair market value, have to be used in an active business. We call these good assets. Anything else, like extra cash just sitting there or passive investments, gets labeled a bad asset. And if those bad assets make up more than 10% of your company's value, you fail the test. It's a very bright line. To make this really concrete, let's just walk through a scenario I see all the time. Let's imagine we have this great operating company, and it's worth a total of $2.5 million. Now, let's say that this successful company has built up about $500,000 in cash that it doesn't really need for its day-to-day operations. This, right here, is our potential bad asset. So, do the quick math. That $500,000 is 20% of the company's total $2.5 million value. That means only 80% of its assets are good, which is well below that critical 90% line. And just like that, boom, the entire capital gains exemption is off the table. So naturally, business owners ask, how do I avoid this? And that brings us to this idea of purification. Specifically, the strategy of continually trying to purify the company to keep this buildup of bad assets from happening in the first place. Now, there are four main ways people do this. The first two are usually pretty simple, right? Use the cash to pay off debt or buy new equipment for the business. No real tax drama there. But it's those last two, paying out dividends, that can open up a whole new can of worms. Let's dive into the most direct approach first. The business owner sees the extra cash, sees the problem, and thinks, okay, I'll just pay it out to myself as a dividend, problem solved. So here's our starting point. You've got the shareholder, who owns the operating company. And inside that company is that $500,000 of problematic cash. The goal seems really simple, right? We just need to get that $500,000 bad asset off the company's books. Then 100% of the assets left will be good, and we'll sail past that 90% test. And so the proposed solution is to pay a dividend. The company cuts a check, and that $500,000 moves from the corporate bank account into the shareholder's personal bank account. The company is now technically purified. But, and this is a huge but, here's the flaw. While you fix the problem inside the company, you've just created a massive personal tax bill. That entire $500,000 dividend is now taxable income to the shareholder. You've basically just swapped a corporate problem for a personal tax nightmare. Okay, so because of that huge tax bill, advisors will often suggest a more, let's say, sophisticated structure. To get around that immediate tax hit, they recommend putting a holding company into the picture. Now, on paper, this looks like a genius move. Instead of paying that taxable dividend to you, the individual, the operating company pays it up to another corporation, your holding company. And under Canadian tax rules, these kinds of intercorporate dividends are typically received completely tax-free. Sounds perfect, right? So the new setup looks like this. You, the shareholder, own a holding company, and that holding company now owns the operating company. It's a really common structure, but for purification, it lays a very clever trap. So you do the dividend.
The operating company is now pure. It passes the asset test with flying colors. But that $500,000, it didn't just disappear. It's now sitting as cash inside the holding company. You see what happened? The bad asset wasn't eliminated. It was just moved one floor up in the corporate structure.
And here's the trap. Now the holding company itself is the one that fails the asset test. And to claim the exemption, you have to sell the shares of the holding company, not the nice, clean operating company. So the whole strategy just falls apart. And even worse, you're now left with this more complicated structure that can be a real headache to sell to a potential buyer. The core problem is still there.
So this brings us to a really important conclusion about this whole strategy. Trying to proactively purify your company every single year using dividends, well, it often just leads you down a path with some really significant tax and logistical roadblocks.
And you don't just have to take my word for it. As tax professional John McRoy points out in his own analysis, the end result of this holding company strategy is that you just fail the asset test at a different level. And, as he says, for that very reason, experts don't consider it to be the preferred solution. So let's wrap this up. The takeaway is this. While the idea behind ongoing purification makes sense, trying to do it with dividends is a really flawed game. You either trigger a giant immediate tax bill, or you build a complex structure that still fails the test in the end. And that, of course, leads us to the most important question of all. If this common strategy really doesn't work that well, what is the better option? What is the right way to manage that excess cash to make sure you actually qualify for the capital gains exemption when it's finally time to sell? And that is a great topic for another day.